Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a family office network based in Greenwich, Connecticut. I'd like to take a minute and thank all my listeners and supporters in 60 countries globally. I do read your emails and messages and appreciate your comments. I was especially pleased to find a listener at a conference in Cambridge last week who particularly liked the Francois de Fischer episode. If you haven't already, please do like and subscribe and leave a review, even if it's just a thumbs up. I greatly appreciate it. Michael Psaros didn't learn about the power of capital in a textbook. He saw it firsthand in the 1980s as the steel industry collapse threatened to extinguish his hometown of Weirton, Virginia, which ultimately led him on to a career in private equity. He is the co-founder and managing partner of KPS Capital Partners, a private equity firm that invests in manufacturing and industrial companies worldwide. Most of Michael's deals involve the surgical extraction of non-core businesses from global giants, and we break down the mechanics of the corporate carve-out, why KPS runs a highly concentrated portfolio of only 10 platform companies per fund, and their buy and build strategy that has transformed failing industrial divisions into global leaders. Michael serves on the investment and management committees of KPS, which manages about $19.5 billion in assets, and its portfolio companies generate over $21 billion in annual revenue, operating more than 200 manufacturing facilities across 21 countries with about 55,000 employees. Previously, Michael was an investment banker at Bear Stearns. He earned a finance degree from Georgetown University and studied at Sophia University in Tokyo. He currently serves as vice chair of Georgetown's McDonough School of Business and helped establish the Psaros Center for Financial Markets and Policy there. Please enjoy my conversation with Michael Psaros.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
My curiosity starts with, why didn't you go into politics?
I always here's the truth. Growing up, I always thought I would go into politics at some time. One of the greatest experiences I had in my life, in my formative years, in my youth, was I'm a West Virginian, and I went to Georgetown University as a freshman the same year that Senator Rockefeller, who was Governor Rockefeller, was elected to the United States Senate, and I was one of his first interns.
With Jay?
Having the opportunity for 2 years to shadow a United States senator, especially when his name is John D. Rockefeller IV, was an extraordinary experience. I can't tell you how much I learned. And one of the great things about being an intern is even at a young age, you receive a Senate pass. And I was a finance major, and in 1987, obviously, we had the big stock market crash. And I skipped classes, I don't know how many classes, for how many months. And I had the great privilege of attending the congressional hearings that were hosted at the time by Congressman Markey, who's now Senator Markey. In Washington, in the legislative process, has always fascinated me. The reason that I didn't take the next step to go into politics is because life gets in the way.
Wait a minute, you skipped class to go to the hearings?
I did, because I knew that I had the opportunity to be a witness to history, and those congressional hearings were historic. This is the stock market crash, when the market fell by over 20%. And everyone wanted to know why. And the conclusion of all those hearings is, to this day, we still don't know why there was a crash. Obviously, back in the late 80s, you had a huge run-up in interest rates. You had a confluence of events, but none of them turned out to be nefarious, which is obviously the purpose of congressional investigations. But it was fascinating. It went on day after day. And I was there, standing in the back against the wall with my little intern badge.
And then why did you go into politics?
I didn't go into politics because, as I said, life gets in the way. We started this firm. We built this firm. I have my first duties and obligations, ethically, morally, and as a fiduciary, are to our investors, to whom we've made many promises, to my partners, and to my family. So instead of going into politics, I asked myself, And I actually think my decision was much better than actually running for elected office. When you run for elected office, you're in that office for a finite period of time and it's fleeting. But instead, I made the decision to make a major investment. I am almost $15 million invested, and that will increase by 7 figures or more every year, as long as God gives me years, into the Georgetown University Psaros Center for Financial Markets and Policy. There was no policy center in the United States at the nexus of the capital markets, legislation, and regulation. Georgetown is the intellectual fulcrum of the District of Columbia. Its power to convene, as demonstrated and proven, is second to none. And so you had the world-class Georgetown Business School, you had Georgetown in Public Policy, you have the Georgetown Law School, you had all of the facets there to bring thought leaders in the capital markets and on Wall Street together with the decision makers and policy makers from a regulatory and policymaking standpoint in Washington to move in. This is not, now we do very deep research, but it's not just about writing peer-reviewed academic papers. What we're about is moving policy and practice in the real world. And so I put my name on the center. My family did around 3.5 years ago. And I really can't believe the impact that we have had already. Just last week or the week before, we had Federal Reserve Chair came and gave a major policy speech. When Vice Chair of the Federal Reserve, Mickey Bowman, became Vice Chair, she gave her first policy address at the Georgetown Psaros Center, and she's in charge of all regulation and supervision of the United States banking system. If you looked at our most recent Financial Markets Quality Conference, you had everyone from Fed governors to David Solomon, who's the CEO of Goldman Sachs, to the chairman of the SEC. And the Psaros Center is my family's contribution to the Republic. It is not an act of philanthropy. It is an act of patriotism, and one that we're very proud of.
How does one go about starting a think tank? How did you find the director? And how did you decide what the initial parameters would be?
This is why professors matter. This is why professors and teachers are lifelong mentors, and they matter. I come from a family of educators, my mother, my aunts. When I was an undergraduate at Georgetown, the most important professor that I had was Dr. Reena Agrawal. Dr. Reena Agrawal in the world is recognized as one of the greatest minds as it relates to markets. And she and I kept in touch over the years. And after the failure of Lehman Brothers and at the start of the great financial crisis, Dr. Agrawal, who is the brain trust, so I'm just giving you the answer, she is the brain trust, came to me here in New York and said, as a result of the great financial crisis, there is an enormous amount of proposed legislation and regulation that are going to affect the U.S. and global capital markets. Georgetown needs to be in the middle of this. Can you help? And so in 2009, I made a $500,000 donation to put Dr. Agrawal in business. For the next 10 years or more, she really made bricks without straw. At that time, Center for Financial Markets and Policy had a real impact, but was really underfunded. And I made a decision, along with my family, to really invest in, scale, and platform what is now the Georgetown Psaros Center around 4 years ago. But Dr. Agrawal is the driving force. It's her vision, it's her center, and I'm very proud of her.
Is there anyone who was influential on your own thinking about the markets, either when you were in school or when you were in the industry? Any authors, anybody in particular?
I have to be honest with you. I hope that this answer doesn't disappoint. I am a business media, business book, business history junkie. I have read just about everybody's book, and I will tell you, I have not been influenced by anybody. I cannot say that I read this book or I read this theory and I was inspired. I will tell you who did inspire me, and it was not an investor and it wasn't a Wall Street professional. But when I was a sophomore in high school and from an industrial manufacturing standpoint, the entire world was coming to an end, I read Lee Iacocca's book.
I'm sorry, this was
1980 to 1982, 83, 84. I read Lee Iacocca's book 3 times. That book had a more profound impact on me than any of these investment books, investment theory books that I have read.
Why?
Because of how Mr. Iacocca at that time went about saving an iconic American company and how he laid out his process that he undertook to turn around the company. First, it started with leadership, then it started with vision, and then came execution. In many ways, that's KPS.
What do you think about the way he turned it around? He had almost a nightmare situation when he came in. The firm was basically broke. He had a ton of inventory, and the consumer markets were against him. What would you have done in that situation?
There's a great line from back then, a great story. His CFO was, I believe at the time, Mr. Jerry Greenwald, who has gone on to become CEO of United and has done amazing things. And his CFO went to Mr. Iacocca and said, Lee, we only have something, I'm making this up, like $1 million in the bank. And his response was, okay, what is the best use or the best application of that $1 million? Not to panic, but rather to say, okay, what is the best use of that? That is an anecdote that has always stuck with me. Also, my name is Psaros. I'm the grandson of 4 immigrants. Mr. Iacocca's immigrant success story, what he did at Ellis Island, is just extraordinarily inspirational. So when you put that all together, that's why I read that book over and over.
So maybe you could talk to us a little bit about your theory around platform companies. I'd love to hear how you go about finding anchor businesses and how you think about how you can build on them into the future versus simply an opportunistic strategy.
Our investment strategy is based on seeing value where others do not, buying right, and making businesses better. Manufacturing excellence. It all starts with seeing value where others do not. It is not my eye or my partner Dave Shapiro or my partner Raquel Palmer's or any of our other partners' eye. It is our collective eye. Over the decades, and it has been decades, we have acquired businesses that most other buyout firms would not acquire or invest in. We have an ability, whether it is a non-core business owned by a large publicly traded company that we acquire in connection with a corporate divestiture, or whether it's a standalone business, we have the ability to look at an opportunity and say, we can add value here. And over the years, we have received a lot of awards from the various private equity publications, global turnarounds of the year, global deals of the year. And what's so interesting is that all of the investment opportunities where we won these great awards and made our investors a lot of money were broadly marketed by an investment bank to the global private equity community. And we were either one of a small group of buyers or in many cases the only buyer, which is also why, especially in the size that KPS invests in today, that we also tell our investors any private equity firm that tells you they have proprietary deal flow is lying to you and lying to themselves. But the point that I'm making is that it is our collective eye. We're able to lock on and understand where we can create value, where we as KPS can add value. Once we buy that platform company, we have been a buy and build machine. Let's talk about the learning curve. Over a quarter of a century ago, when we raised our first institutional buyout fund, we were still, in our heart, turnaround guys. And so we would work very hard. We identified the opportunity. We would acquire the company. We would put in a world-class management team. We would improve the business. And what did we do? Right away, we would sell. If you look at the investment returns between our second fund and our first fund, it's a step function increase. And that is because we said to ourselves, we've done all the work. We bought the business. We've made it into a cash flowing, growing, profitable enterprise run by a world-class management team, and we have access to capital. So let's go out now and grow it. Prior to our second fund, we really didn't have that growth mindset. And we acquire companies for purposes of industry consolidation, in terms of product, in terms of geography, and it works because when you are an industrial, synergistic buyer, you're able to buy down your entry multiple the larger you grow the company. We have had some portfolio companies that have made over 15 acquisitions, all off their own balance sheet, financed by internally generated cash flows in their own balance sheet. It just works. We've also done, I just have to say, we've also done very well in many other investments where we didn't make a follow-on acquisition. There was simply no reason to, or we couldn't. So, for example, we recently sold a company called Eviosis. We acquired Eviosis from a publicly traded company called Crown. Eviosis is the largest metal food packaging company in Europe, and we more than doubled the EBITDA of the company. We sold it to a publicly traded U.S. company called Sunoco. The investment bankers will tell you that was the largest sale of a private equity-owned packaging company to a strategic buyer ever. So there's a lot of private equity investing in packaging, but our sale in dollar value was the biggest ever. That was a case where we had approximately, Eviosis had between 42 to 45% market share in Europe. There was no room to buy anything, but we still did. So that is the point I'm making, why we didn't pursue a buy and build strategy at Eviosis was you couldn't.
And what was appealing about it at the time? Why did you get in?
We saw, in our opinion, an undermanaged, non-core business owned by a large publicly traded company. Corporate carve-outs account for approximately 70% of all of our investments. Crown retained a 20% ownership interest. We were in absolute control, and it allowed us to get to work. And the metal can business, at the end of the day, is pretty simple. You buy metal at a price, you convert it at a cost, and you sell it. And we addressed all of the disciplines of the business. We, by going directly to the tin mills in Europe, really leveraged our buy and improved pretty materially what we were buying tin plate for, the metal substrate that goes into food cans. We really understood the market power of the company in Europe, and we were able to take a lot of commercial actions to really increase profitability. We then brought in a new CEO, and we reorganized how the company was being managed, and we embarked on a plant consolidation, reimagination of the company's pretty significant footprint. We had over 40 plants throughout Europe into what I would call a hub and spoke strategy. And so if you buy metal better, and that's 60% of your total cost, and you sell it for more, and in between you improve your cost structure, you create a profitable investment. That's how we did it. It was a 3-year journey from the time that we made the investment almost to the time of sale. It was 3 years. And I'm very saddened the CEO that we had on point who was a dear friend and a true partner, unfortunately passed away within a year of our exit as a very young man.
Did your experience with Weirton help you in understanding that market?
Absolutely. That's why I got excited about it. And I thank you for asking the question. The entire reason that National Steel decided to divest its Weirton Steel division, in addition to the cataclysm in the overall steel industry at the time, was a brand name blue chip marquee consulting firm provided to National Steel and to its board a report back in 1981 and 1982 that there was no future for tin cans, that tin cans were going to be made obsolete by plastics. And so just because of back home, I understood the dynamics of the tin plate business. And when this opportunity was made available, they were saying the same things about tin plate and tin cans 30 years later, almost 40 years later, than what they were saying in 81, 82. No growth, no future, going to be substituted by other substrates. 50 years from now and 150 years from now, we will be opening tin cans. There is no more cost-effective, safer, keyword is safer, way to save, to protect food.
What about the commodity risk? Is that a danger in that market?
We passed through. We were essentially the beneficiaries of the huge spike in the metal substrate, in the steel tin plate costs during our ownership. That was during the early parts of the Biden administration. I think we all know what happened globally in terms of inflation. And not only were we able to pass through to our customers the very material increase in metal costs, but we were able to tack on additional price increases.
I'd be interested to hear about, we'll go back a little bit. I'd be interested to hear a little bit about your mentors and how you started this business with, I think you were on the street for a brief period of time, correct?
Yes. The genesis of our business really interleaves with my story personally. I grew up in a steel town called Weirton, West Virginia, approximately 35 to 40 minutes south of the 50-yard line at Acrisure Stadium in Pittsburgh, home of the Steelers, where I proudly am, with a partner, have a skybox. Weirton is an immigrant town. It is a town where generation after generation all worked in the mill. My father was a senior executive in operations. He was in charge of all of maintenance, but I had cousins who were laborers. I had great uncles that drove trains, and it was all I ever wanted. It is still home. I still proudly call it home. And I thought that I would go to West Virginia U like my dad, get a degree in electrical engineering like my dad, go to work in the mill like my dad, and retire 30 years later. And believe me, if I had that opportunity, I would have been very happy. What happened is in the early 80s, America witnessed the first great cataclysm, and it was a cataclysm in the U.S. steel industry. Between 1981 and 1983, a huge amount of giant integrated blast furnace steel companies closed. Now, please keep in mind that for every direct job in steelmaking, there's 7 indirect jobs. And so through the arc between Johnstown, Pennsylvania, through the Monongahela Valley, into West Virginia, up the river through Ohio to Youngstown, you had so many of these plants close, employing literally in aggregate hundreds of thousands of employees who all of a sudden lost the greatest job that they were ever going to have. And so it was really a disaster. I was a freshman, sophomore in high school watching all of this. In 1982, National Steel announced it was going to close or sell the Weirton Steel division of National Steel. Now, we all knew what that meant was it was going to close. And so there were 10,000 people working in the mill at that time. There was a little over 20,000 people in the town. And so really would have been a disaster. Now, obviously, workers came from outside of the town, but it would have extinguished our way of life, because The mill is at the center of the town in its culture. It is the culture of the city and in the area. And so what happened was is a group of workers came to New York in search of a mythical figure known as an investment banker. And they couldn't get an introduction, but they were finally, through labor, introduced to the legendary investment banker, the most legendary of his generation, Mr. Felix Roten at Lazard. They went in to see him, and he had a 30 or 31-year-old vice president with him named Eugene Kalin, who's the K in KPS. And Mr. Roten turned around to Gene and said, you are going to figure out how these guys are going to buy their company. And on January the 11th, 1984, the independent Weirton Steel Corporation came into existence. Gene did it. Gene made history. It was the largest employee buyout in the history of the world at that time. It was major national news. There were lemonade stands being done at ESOPs, but nothing like this. This was billion-dollar enterprise. So it went on to become business school cases, Time, Newsweek, a PBS Channel 13 documentary. It was a landmark event. And here's what I observed, and this informs, to this day, everything that we're about. It was the first time that capital and labor, who are usually anathema to each other, partnered, labor, management, capital, to buy the business and make it a success. The company went public in 1989. So once Gene saved all these jobs, you can imagine all the phone calls started to come in. This was the 1980s when industry was really falling apart. And Gene and a gentleman named Ron Bloom, who was a young associate at the time out of business school, went on in the 80s to do an extraordinary body of work. All manufacturing, all industry, all turnaround at Lazard. They left Christmas 1990 to start their own firm next door at 230 Park. Now hold that date, Christmas 1990. So here I am in high school, and this young man saves our entire town. And I said to my dad, I want to be him. I don't want to just be an investment banker. I want to be Gene. I want to be involved in industry manufacturing and saving towns like ours. And so my dad went to his friend who was the CFO of the company. He put us on the phone with an investment banker, and to this day, I don't know who it was. I wish I did. And he said, kid, if you want to be an investment banker, go to Georgetown or go to another school and you'll work on Wall Street. I had family in Washington, so I went to Georgetown. I graduated. I became a trainee kid analyst at Bear Stearns. 2-year experience that I loved more than you will ever know. I love Bear Stearns. I love the culture. I love the people. It was just the capital E entrepreneurial. And I loved it. But I was a 2-year trainee. And as I was ending my second year, I got a call from back home that Gene had left to start his own firm. This would have been 4 months prior. I walked across the street from 245 Park to 230 Park with an introduction, of course. Gene couldn't believe the story, hired me on the spot. My partner, David Shapiro, was hired 2 weeks before me, and that was 35 years ago. And the rest is kind of history. But so my story and the firm's story are really one. So between 1991 and 1996, the summer, we did exactly what we're doing today as KPS, except we did not have an institutional pool of capital. We were putting together these buyouts. We were bootstrapping them. A lot of the companies we were buying had very significant fixed assets where you could lever against them on a fixed asset collateral coverage basis, but we weren't capturing the upside. In the summer of 1997, I said to Gene and I said to David, and we had been joined over that period of time by a 21-year-old recent Stanford graduate, Raquel Palmer, our co-managing partner, who built this firm along with us, and someone who really changed my life. And I said, we really need to raise a first-time institutional buyout fund, which is very hard today, but back in 97 was really hard. And we substantially all, if not all, of our deals over that period of time were financed by GE Capital. GE Capital was the most prestigious company in the world, most prestigious industrial company in the world, and owned the third biggest bank in the United States. And we took that document to GE, and we said we need two things. We need a $10 million for the $100 million fund we're raising, and we need the use of your name. And they gave us both. So the first line in our first PPM said, Gene, Dave, and Mike are seeking to raise a fund with $100 million in capital commitments, period. Second sentence, General Electric has agreed to invest $10 million. Because of that second sentence, and not because of the first, we raised $210 million in 3 months. And back then, a $210 million first fund was a big deal.
These are institutions?
All institutions.
Endowments, foundations, pension funds.
Substantially all of our investors were then and are today a pension fund. Today, we have investors from over 30 countries, and they still remain pension funds. But that is how we got into the private equity buyout business, and we have not looked back.
So tell us how the execution of that first fund went. How did you folks, so you're a nascent firm, small group of people, how did you folks gel? How did you divvy up the work? How did you divvy up the universe of companies you were looking at?
I would like to speak to the word that you used, gel. Remember, at that time, Dave Raquel and I had already, and Gene, before he retired, had worked together for 6 years. So we had developed a family-owned, and we still have a family-owned culture over those 6 years. And one of the consistent comments that our investors make about KPS in 2025 and in all the years since is that they rarely encounter a firm with our culture, a family-based culture, a culture based on character, integrity, veracity. We have no attribution here at KPS, which is unusual for a private equity firm. Every deal ever done since we created the firm as an institutional buyout firm has been led by a partner that is with us today. So when we do fundraisers, when we're asked for attribution, we write 3 letters, KPS. And if an investor is not comfortable with that, then he doesn't have to invest with us. And that culture was created back in the early 90s, what you said, gel, okay? And it's still the same today. There is really nothing that I wouldn't do for my partners and their families and that they wouldn't do for mine. I just became a grandfather, and the first time. And my partners were there for my daughter's first birthday, and my partners were there to see her get married 27 years later. And now my partners have seen me become a grandfather. This is not Wall Street. You just don't hear this. We go into meetings and we will sit with the management team for 5, 6, 8 hours, sometimes longer. And all we have to do is look in each other's eyes, and we just speak volumes back and forth to each other. We don't even have to speak. We have complete trust in each other's judgment and complete trust in each other. And so, to use your term, we really, even today, don't sit down and divvy things up. So think about who we are. All we do is invest in large global industrial and manufacturing companies. And so we're all interchangeable because we all invest in the same thing. We don't have silos. It's not we have an auto investor or a paper investor or a metals investor. We're all completely interchangeable.
But are there different attributes that the partners have that are additive? Does David specialize in anything in particular or have a particular perspective?
I apologize to repeat myself. We really don't specialize, but we all have incredibly different personalities. We all have incredibly different perspectives. We're all from different parts of the country, and it all works. And what is remarkable is that we could discuss an investment opportunity. We could discuss managing the portfolio. We could discuss whether or not we should pursue an acquisition, or fund a CapEx project, and we could start with completely different perspectives, but very quickly we made it to 50. I cannot think, as it relates to investing, as it relates to owning and operating an industrial enterprise, a disagreement that we have had over the collective tenure of this firm. We've had lively intellectual debates, but we've never had an argument. People ask me, I guess it's logical. I have no idea how other firms operate. They ask me about our investment committee meetings, how our investment committee deliberates, and it is a strange concept to me. Each of our funds, which take 4 to 5 years to invest, only invest in 10 platform companies. That's been the number. Not by design, but KPS Fund 1, 2, 3, 4, 5, and MidCap 1, 10 companies, but generally speaking. And so when you're only investing in 10 platforms, every single investment from the first meeting all the way to the day you sell is discussed in circular amongst not just our partners, but really the entire firm. This is why I use the term interchangeable. And so by the time that a potential investment is at the investment committee, everyone knows everything about the company, the result of all of our diligence, what the issues are, what we intend to do with the company. And so the investment committee, it's like a perfunctory exercise. And all of our partners participate in our investment committees. And so we are not a firm where you have, in quotes, this deal team that is off doing its thing that shows up to pitch its investment idea or to get approval for an idea to a group of wise people on an investment committee. That's just not how we work.
How many partners do you have?
We have 7 in our flagship franchise and an additional 2 in our mid-cap franchise. Our average hold period has ranged between 4.2 and 4.8 years.
Okay.
Over the years.
I think it's interesting that you folks are very concentrated. It's a small number of people making these decisions, and you're all involved in all of these companies. I suppose you're all involved in also the larger, the top of the funnel, so everybody's looking at the same firms.
Yes.
Do you do it, is it an investment memo kind of thing? Is it a day-long meeting? How do you make these decisions?
That investment memo, as you called it, is many inches thick. And these meetings can go on for a very long time. Now, keep in mind that by the time a potential investment has reached the investment committee, we've probably discussed it dozens of times, literally dozens of times. And so that final meeting is more like a bring down update. And so it's iterated all the way until we make the investment.
And what is the sweet spot for KPS? What kind of firms are you looking for?
Approximately 70% of all of the capital that we've invested has involved creating new companies to buy non-core businesses from large global publicly traded companies. We love carve-outs for so many reasons. First is that for most, not all, but for most sellers, they have owned these businesses for decades. And the primary objective of the seller is to sell the non-core business to a competent owner. And so our track record of, we believe, I should say, our track record of owning and operating large global industrial businesses is second to none. We believe our ability to execute highly complex corporate carve-outs on a global scale is second to none. And our track record in respect of this speaks for itself, and sellers see that. And why this really matters to sellers is that very often when they sell a business, when they divest a business, the seller will continue to supply the same customers with product. And so if the new owner of this business doesn't do well, the customers will hold the seller responsible. In addition, the businesses that we buy very often in connection with corporate carve-outs continue to be critical suppliers back to the seller. And so they have to pick a firm that knows how to own and operate global industrial businesses. And then if you think of the word carve-out, you are literally taking a knife, you're reaching into the corpus of the seller, and you're carving a business out. If that carve-out doesn't go perfectly. It just doesn't harm the business that we're acquiring. It can do great damage to the seller. And that's why we take great pride in connection with carve-outs. Safety is really a critical part of our DNA. When our portfolio companies report every month, the first thing that they report on the first page is their safety statistics by plant. The first thing that we look at in every quarterly board meeting is safety statistics by plant, by company. Last week here at One Vanderbilt, we had every one of our flagship portfolio companies present their 2026 annual operating budgets. The first thing they presented was their safety statistics. It is mind-boggling to me that, and we hear this in stereo, that there are private equity buyers of manufacturing and industrial companies that through the acquisition and diligence process don't make inquiries into safety, because that's how if a company is being run or not. Companies that allow their people to get hurt are not well run.
Are there any other metrics to measure the success of your underlying companies that you look for that might be different from the industry, or things that you've noticed over time that are better indicators than, say, the standard textbook?
We've discussed safety, quality. In many cases, market share is a proxy for quality, delivery, and customer service. They tend to go together. Even in commoditized businesses, quality, delivery, and customer service all go together. And many times, in the first instance, when we're looking at a business, market share is a proxy for that.
So this firm, clearly it's quality over quantity versus a lot of other PE shops, especially the larger ones. I'm curious how you think about managing risk across the portfolio.
We are a micro opportunistic investor, and every investment that we make sinks or swims on its own. The one thing that we manage that you have to when you're only making, generally speaking, 10 investments in a portfolio, in a fund portfolio, is industry concentration. And so we're very cognizant of industry concentration. I'll say one other thing about concentrated portfolios. Every private equity firm, every private equity guy likes to refer to a management team as his partner. When you make 10 investments over 4 years, that management team, those management teams, they're your partners. They get to know you. They get to know your family. When you're only one of 10 investments over a 4 to 5 year period, you're a true partner.
What is the positive case for tariffs?
First of all, on the subject of tariffs, we had a discussion about politics. And so I don't think, as long as the Trump administration wants to maintain this tariff regime, I do not think it's going to go away. The tariff regime, and the numbers have been all over the place, but let's be conservative. The Trump tariff regime is expected to generate well over $300 billion of revenue. And this is just speaking very personally, not on behalf of the firm, it is so hard to raise revenue for the government. And Trump has created this revenue machine. Here's where I am on tariffs. And I want to remind you and your listeners that we are global manufacturers. We own and operate well over 225 manufacturing facilities in over 24 countries. We have built manufacturing plants in well over greenfield a dozen countries. We have cut red ribbons. We have cut yellow ribbons. More than half of our portfolio company revenue is generated abroad. More than half of our employees are abroad. And so I don't want your listeners to say, oh, he's a U.S. manufacturer talking his own book. Here's the bottom line. The bottom line is that over the last 35 years, over 60,000 manufacturing plants closed in the United States. One plant alone somewhere could employ 10,000 people. No other country in the world would have allowed 60,000 manufacturing plants to close. Not Britain, not Germany, not France, not the Benelux countries, not Japan. Just would not have been allowed. Just look at what's going on in the steel industry today in Britain, where they're trying to de facto nationalize their last two steel companies. Do you know what happens when a plant dies in a small town? You have first spousal abuse, then you have divorce, then you get crystal meth, then you get opioids, then you get the brownfields, and then you get death and destruction. That is how important a plant is in a mill town. And we allowed 60,000 plants to close. And so there has been no such thing as David Ricardo comparative advantage or win-win free trade in manufactured products in the world. Anybody that believes that there is free and fair trade in industrial products really doesn't know what he's talking about, maybe lives in the ivory tower. Who has benefited from this? Wall Street has benefited from this. The benefits have inured to capital, not labor. And so tariffs are a very blunt instrument. And prior to President Trump, they were targeted, they were adjudicated, there were, generally speaking, rules on how to implement tariffs. But I am all in favor of leveling the playing field where the playing field needs levered. What is before the Supreme Court is whether or not the executive branch has the right to implement blanket tariffs by country, by geography. And we'll see how that plays out. But most experts think it can be replicated. And if you have a Democrat president, which could 3 years from now, I just can't see, even if the Democrats have the presidency and all branches of Congress, walking away from $300+ billion of revenue. I want to remind you that Joe Biden did not repeal one single Trump tariff from the first term. Not one, but no one talks about that.
So you've been deep in manufacturing your whole life.
Yes.
What do you think the case is for reshoring? Do you think that there will be an industrial renaissance, or should we temper our optimism?
So I've had this discussion, I don't know with how many United States congressmen, how many senators, and how many of our KPS LPs over the last couple of years. Let me just say the following. Reshoring is for real. It is very for real. What happened was, since China came into the WTO, you had this supply chain stretched all the way to Asia in a very material way. When you manufacture abroad, especially everybody is just in time today, there's a big ocean out there. And so you have to transport products a very long way. You have to tie up a lot of working capital because you're transporting product or component parts a long way away. And especially coming out of COVID, there is a real, from a national security perspective, from a corporate protection perspective, a real impetus to reshore to the United States. It is not just, I've been asked by some smart folks, is this just an exercise in construction? It is not just an exercise in construction. It's for real. So it's going to, but it is going to take time. This administration has announced hundreds and hundreds of billions of dollars of investment that's going to occur in this country. It takes a long time to permit, construct, test, and certify a plant prior to getting it in construction. The discussions that are had every day on TV, when are we going to see the results of all this investment? There's guys like us that have an enormous investment in plants abroad. You're just not going to walk away from plants abroad. But we are central to, and I should have led with this, central to KPS, our DNA, our ownership and investment philosophy is manufacturing in region for region. We manufacture in Asia, we source, manufacture, and sell in Asia for Asia, in NAFTA for NAFTA, and EMEA for EMEA. That is why the tariff matter has not really affected us very much, because we manufacture in region for region. So the onshoring to the U.S. is real. It is good for our national defense, good for our national security. It will be great for our balance of payments. It will be great in terms of restarting the virtual cycle of technology that comes from not only R&D, but the intellectual property that is acquired all the way through the manufacturing process. Here's what it's not going to do. It's not going to create any jobs. This is what politicians just can't understand. In modern manufacturing, especially the manufacturing that we are talking about here in the United States, capital has substituted for labor. Automation has substituted for labor. So we talked about my dad. At the peak of his career at Weirton Steel, it took 10 man-hours to manufacture 1 ton of steel. Today, it takes, in modern steel making, 0.35 man-hours per ton. So rounding numbers from a labor efficiency perspective, modern steel manufacturing is 30x better than it was when my dad was at the peak of his career. If you walk into so many of our plants, you will see the automation at work. We have one portfolio company, our big automotive parts platform, where you will go into a plant and see 600 robots working 24 hours a day. And so there's going to be a huge investment in American industry, but it'll create a marginal amount of jobs relative to the overall employment in the United States, and it's just not going to move the needle.
And how does AI affect that?
I haven't figured that out yet. I think it's way too early to figure that out. I don't think anybody knows at this point. I will tell you that I don't believe that AI will make our blue-collar shop floor workforce any more efficient, because we have already manned to the most efficient levels. The impact on our white-collar workforce, that remains to be seen. But here's the holy grail for AI in manufacturing. And I don't know if this is 2 years from now or 10 years from now. So substantially all of our businesses over the years, with the exception of 2, which was TaylorMade and Waterford Wedgwood, supply another business. So our automotive parts platform, for example, is supplying all of the big car companies in the US. So we sell to other businesses. We have to rely on our customers almost daily, in some cases where you have electronic order entry, to tell us, in my example, how many cars of this platform that we're on do you think you're going to sell next week, next month, next quarter? We have had some of the world's largest companies that we have supplied, most sophisticated, be off on a quarterly basis by a standard deviation of 50%. So that means we have to man the facilities to supply the demand that we've been told. We have to have the raw materials and therefore the working capital tied up. And we're really at the mercy of our customers. What AI is going to do is the big giant mind in the sky, looking from all of the macros to the micros. If it can help our customers with predictive demand, it will change our businesses. If you could take that 50% standard deviation down to 10%, because you're never going to be perfect, it'll have a huge ability for us to plan, schedule, man, and resource our plants. And I think that will happen. I just don't know when. There's been too much talk through the years of manufacturing 2.0. Manufacturing 2.0 was a great slogan to get your stock price up, but I haven't seen the effect of manufacturing 2.0 on the shop floor. I think predictive demand will be the most tangible, impactful thing in aggregate overall for our portfolio.
What do you think about all the fads that have come and go over the years about reorganizing the shop floor? Six Sigma, all these various frameworks. Have you folks developed your own framework?
Thank you for using the term fad, because that's what they are. There is only one big bang. There is only one revolutionary process that matters, which is going back to the 1970s, the creation of the Toyota production system and what came out of corporate Japan in the 1970s and 1980s. Please remember, I was a Japanese language minor and
Studied there.
I studied there at Jochi Daigaku, Sophia University, Jesuit school, ranked number 4 in Japan, in Tokyo. And I have studied...
Wait, why did you go there?
So going back to Weirton, remember, American industry was flattened in the 80s by the Japanese. Flat. And so why wouldn't I, if I was interested in manufacturing, why wouldn't I want to study Japanese? Why wouldn't I want to study everything Japan, which is what I did back when I was a kid. And when I was in Japan, which was in the summer of 1988, the summer before the bubble burst, I was there at the peak. I was there when the land value under the Imperial Palace exceeded the entire state of California. Okay. Through my father, we didn't have the internet back then and cell phones. Through my father and his vendors and his connections in snail mail, letters of introduction went to various, probably a dozen major Japanese companies. And while everyone else was at bars, I was on the bullet train and I was visiting Japanese plants in the 80s, okay? And so the Toyota production system and everything that goes along with that changed industry. So to this day at KPS, our operations group, their prime directive is implementing the Toyota production system in all of our manufacturing companies, irrespective of an industry. That is the alpha and the omega. Everything else is, as you said, is just fads.
Philanthropy has always been very important to you. I'm wondering if your experience in private equity helped you in the remarkable story of rebuilding St. Nicholas after the Trade Center collapse.
Absolutely. For your listeners, there was a small church, the only church on the entire 16-acre campus of Ground Zero, called St. Nicholas Greek Orthodox Church, that was tiny, and it was obviously destroyed on 9/11. The decision was made by Governor Pataki, at the time New York City, the Archdiocese, to rebuild it, but in a much grander scale. The Archdiocese hired Santiago Calatrava, the world's most famous architect, who designed what is an architectural masterpiece that I encourage you all to visit at Ground Zero. In the first 3 years since the National Shrine has been open, we have attracted over 600,000 visitors. But around 15 years into the process, the construction of the National Shrine failed. Basically, the original cost estimates to build the National Shrine were $40 million. The ultimate cost to build the shrine, along with soft costs, are closer to $90 million. And Ground Zero is the most expensive place, by the way, probably in the history of Western civilization to build because of the specs. And so the Archdiocese failed in its effort. The project was wrapped in a garbage bag for 2 years, almost 3, in the middle of Ground Zero. And what we do at KPS is we make businesses better. We fix things. We're turnaround guys. That's who we are. And so I saw an opportunity to do a turnaround. And so working with a gentleman named Dennis Meal and a priest named Father Alexander Karloutsos, who, by the way, is winner of the Presidential Medal of Freedom, we put together a board of the leading Greek-American business people, and the Archdiocese essentially gave us the authority to fundraise and construct, and we have created, as I said, an extraordinary architectural masterpiece. It's made from Pantelic marble, which is the same marble that Pericles used from the same rock to quarry the Acropolis and the Parthenon, the only time it's ever been allowed to leave the country. And for those of you listening, it has become the ecumenical convening space in New York City. We are open to people of all religions, of all creeds worldwide. Anytime there is, whether the UN, during UN week, wants to have an ecumenical convening, it's all now at St. Nicholas. St. Nicholas is also to use a Greek word, the cenotaph, like the tomb of the unknown soldier, for the 3,000 people who were martyred and murdered that day. So it is a place of remembrance. It's a place of forgiveness. So please come visit us.
What's the secret to breaking a logjam like that? There was a lot of interested parties involved.
Oh, you had the governor, you had the Port Authority of the state of New York and New Jersey, you had New York City. Oh yeah, this is New York. So obviously you had a lot. The answer is the credibility of the board that we had assembled. All business people whose only thoughts were altruistic, and our donor base understood that, number one. Number two was full transparency. Having blown it once, couldn't blow it again. So every single dollar that was raised and expended was disclosed pretty much in real time. And so between January 2 of 2020 and the onset of the pandemic, we were able to raise over $50 million, which is a lot of money. And we raised another 10 subsequent to that, but we were able to raise the money prior to the pandemic.
Mike, thank you for joining us and sharing your wonderful insights.
Thank you very much. I really enjoyed this discussion because it wasn't just about our firm, but also all the macros that we discussed, from manufacturing to politics to policy to even religion at the end. So thank you.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.